Congratulations for taking ownership of your financial plan by tuning into the Federal Employee Financial Planning Podcast, hosted by Mason & Associates, financial advisors with over 3 decades of experience serving you.
Welcome to the Federal Employee Financial Planning Podcast. Today, we're discussing investing principles, how to structure your investment portfolio. In today's episode, we're covering things like mutual funds versus ETFs and individual stock positions. We're going to talk about your cash strategy, what is a dollar cost average, and municipal versus corporate bonds. Be sure to listen till the end, where we discuss the difference between products, investment aggregators, and financial planners. Unlike many content creators, we're financial planners first, and we do this second. In each episode, we share real-life experiences from decades of helping federal employees navigate complexities of their benefits and all areas of their financial plans. Tommy, welcome to the Federal Employee Financial Planning Podcast.
Thank you, John. Always great to be here. Excited to crank out another episode, and we think some really good foundations we'll go over today. So looking forward to it.
You know, investments are something that you and I don't get overly excited about most of the time. I will caveat that where I was feeling pretty good about myself December 31st of 2024, looking at our net worth, looking at how the investments performed, looking at the Mason & Associates client returns. And I was like, man, this was a fun year. So I don't typically get excited about investments themselves, but it would be kind of a fib to say I don't get excited about good performance, because it's always nice to have that.
Yes, I agree. That whole wealth effect that they talk about. And, you know, we know to not be emotional, but we go through bear markets and bull markets, so we get excited. I'm with you, because I know it's like we should probably be stoic and not get excited about these good years of returns, but we also had just recently came through a bear market. So it's nice to see that. I agree. And it's hard not to be excited. But we always want to have that long-term perspective, which I know we'll be chatting about today. But yes, we get emotional too, but I think we recognize it. And we come back to our principles anytime we begin to question ourselves.
And I think we're good specifically. You know, we've gotten better over the years, 15 years of doing this, where I think we allow ourselves to really enjoy the good years, like seeing our client assets go up last year, seeing clients have a really good year in retirement, seeing our personal accounts grow, allowing ourselves to enjoy that, and then also allowing ourselves to be like, man, 2022 really was pretty terrible, and embracing that emotion too. And knowing one of my favorite things about investing is remembering that remembering that no action is action. No action is action. So in 2022, we didn't panic. Like, did I feel good about life in 2022? Some aspects, but I didn't feel good about the market. And it went down and it didn't feel good and it was really frustrating. And I'm not going to pretend for the audience's benefit that it just didn't affect me. It's like, no, it did. Like, I did not enjoy 2022, but that doesn't mean I made a change.
Intentional. Right. I love it. I agree. Yes, we're human. We feel it too. We don't enjoy a bear market more than anybody else does. Maybe we're disciplined about it. And we know that a lot of times taking no action was the intentional action, because in investments, we don't want to make rapid, knee-jerk moves. We want them to be intentional. A lot of times in life, people unintentionally take that action, right? They stick your head in the sand. No action is still taking an action. We just want to be intentional about it. And a lot of times, investments, long-term focus. You have to always try to come back to that.
You know, we didn't say in our intro active versus passive, but I think that's where we should start in our kind of investing 101 or investing principles, whatever we end up calling this episode. And that ultimately you have to decide, what is your investment philosophy? Are you active or are you passive? And then we can talk about the tools that we use in that underlying strategy. For our audience's benefit, we would classify our investment management style as strategic or passive, which means we want to have global market exposure. We want to have access to all asset classes. And we will make some tweaks from time to time, but we're not going to take huge bets. And we may even employ or use an actively managed bond fund, like a Voya or a PIMCO or what have you. And we're going to allow that active manager to do their thing, but we're not like swapping positions all the time throughout the year. We're not materially, Tommy, going from 80% stocks down to 50 and anywhere in between. We're certainly not going to cash based on what we think is going to happen with tariffs. Today's April 2nd. I think President Trump's calling it Liberation Day. We'll see how that reverberates by the time this podcast is released. But there's a fundamental difference, Tommy, between active versus passive.
Yeah, yes. And part of that's like the timing of the market, which we don't do, right? Like we just hands down, we're not trying to time the market, figure out like this is the time to get out and the time to get back in, because there you had to at least be right twice, which is almost impossible. Some of the world's greatest investors who are even, you would say, active, like a Warren Buffett, which, by the way, his strategy is is to like take control of a business or have a pretty strong interest in it. So he's not like a minority shareholder, but he's a very long-term guy. And he would tell you he's not trying to time the market. Now, he does keep a lot of financial resources around so that when the market is panicking, he can act and take advantage. But different guy. Main thing I wanted to say there is he would tell you don't try to time the market, and investments are long term. So for what it's worth, probably one of the brightest minds in investments. There you go. We don't try to time. And from further in that active, passive, that's a big one. And John, as we were talking about this, to take a step back, maybe it goes in line with it of like timing and active, is we think a lot of value, not only aligning your investments to your financial plan and what you're trying to accomplish and what works for your plan, is let's try to just avoid doing dumb things. That's that's really a big part of the strategy. And I say it, I don't mean to be harsh there of doing dumb things. It's like acting or reacting emotionally or going to the latest craze. Half the time, just avoiding those things and sticking to a strategy gets you 90% of the way there. So that's a big principle, is let's not just react to things. Let's try to avoid, stupid or dumb is a harsh way to say it.
Mistakes.
Try to avoid some mistakes is half the battle. So that's a big one. And then we're passive strategic, but we do have some satellite positions. They're not huge. And some of that is allowing, as John said, trying to allow a bond manager to add some more diversification to it, right? Like we're diversified, we've captured the market, we've captured the asset classes. Now we think that this fund, this company, these individuals, with a small weighting, nothing huge, they can round this out a little bit and potentially add some value, if nothing else than just diversification. And even the same on the stock side, just to give us a little bit more of a well-rounded portfolio, but by and large, passive strategic with some tweaks here and there.
So avoiding mistakes, I think, is very important, Tommy, and avoiding dumb things, avoiding mistakes, avoiding things that could be catastrophic to your financial plan. And an easy way to do that, to avoid mistakes, is just not making any calls, being invested all the time, being invested broadly diversified, and letting the market give you whatever it's going to give you. And in order to not make a mistake in that scenario, we have to acknowledge as humans, that there's going to be a 10% drop once every year. There's going to be a 20% drop every 3 years, I think. And then every once in a while, you could see a 30 to 50%. Mm-hmm. And where you make the mistake is if you freak out and go to cash, or you freak out and pull out of the market. That's that mistake. The active tactical, or the active or the active tactical, every time you make a trade, you're opening up your portfolio for a mistake. Am I in the right asset class? Should I be in? Should I be out? So there's a lot of opportunity for mistakes. There's a lot of opportunity for heartburn if you go into that strategy. So I think about right now a little bit Tiger Woods. We're getting really close to Masters at Augusta. And I saw a YouTube video the other day, Tommy, where it was like 5 or 7 people, Brooks Koepka, Shane Lowry, a few others, were talking about how they prepare for Augusta. And Shane Lowry said, I can tell you exactly what tee shot I'm going to hit on all 18 holes at Augusta. And I hit the same tee shot every time. He's not going to deviate. He's not going to change. He knows his plan going in. Whatever wind direction, he's going to hit that shot. He said he learned so much from Tiger Woods. And the thing he learned from Tiger Woods when he played with him was how Tiger Woods shot 4 under, I believe, in 2020. And Shane Lowry said he didn't even play well, and he shot 4 under. But he always missed to the right spot. He never went into the bunker on hole 3 or 4. He missed the green on 15 to the right side. He knew exactly where he was going to miss on every shot. He plotted his way around the golf course conservatively to the right spots, gives himself an opportunity to make the putt, didn't have to be a hero on every shot, and he's won the second most majors of all time, 80 plus wins on the PGA Tour. There's something to be said for missing in the right spots.
I love that. That analogy there, very strategic, and some would say probably boring, but a lot of times
very boring.
Yeah, but it's the strategy that works most of the time. So that's a great analogy. I was thinking, John, I don't necessarily want to spend way too much time on passive and active because we have other things to cover, but I certainly don't mean that to move you on if there's additional ones you want to hit. But on the active passive, we do believe that active management can work. We just think it's much harder. It's much harder to be consistently correct. And typically, it's a more expensive strategy. So when you factor in, and we'd even say could be emotional, depending on what type of active management we're talking about. If we're trading quite frequently, that to us is very emotional because you're wondering, like, did we get the trade right? Are we where we need to be? All these things John went into. But it's even the market's here and it's pretty reliable, and we're investing in the economy. We're just betting in that these companies, diversified, are going to work by and large, and that the market by and large is going to make the adjustments for us, because companies that fall out of favor, they disappear or go lower in the weighting and the others come up. So it's kind of just designed to already work for you, whereas active has to overcome that, and there's just fees involved with it. So a lot of times it's, hey, we can get to a better place, a more predictable place, and not even have to worry about overcoming that additional fee barrier. The other nice thing about, as I think about like the passive strategic approach or being that diversified, as you say, kind of let in with, is market moves quick. That's one why it's hard to time it right, because it can move very quick and in ways that you don't expect, and sometimes irrational ways. But trying to time that is very hard. And a lot of times when those gains happen, I mean, when lightning strikes, you want to be there, right? Because we just see a lot of times the market kind of flies along and then all of a sudden, boom, takes off. And if you're in the wrong asset class, you weren't there when lightning struck. So this is why we want kind of some just analogies around the different philosophies here.
Lightning struck in March of 2009, right? When the market rebounded like 50% in a matter of months. Lightning struck during COVID very fast after a 30 to 40% drop. Lightning struck again at the end of 22 going into 23, or maybe it was mid 23, whenever it was, 23, yes. Lightning struck, and lightning will strike again. And to your point, Tommy, just being in the market, being there, we always mention to our clients, control what you can control. And we can't control the stock market. We can't control, algorithms and AI and whatever investing craze is coming our way. But we can control a lot of other things, and letting the market just give us solid, predictable returns is a good way to go. I do want to acknowledge, the idea of active management. If you are a very emotional investor, meaning you're going to freak out when the market goes down, maybe you would benefit from a portfolio strategy where somebody's going to get you in and get you out and move you to cash and et cetera. And at least if you, arguably just sticking to that is better than you trying to do the passive thing and freaking out all the time, right? So whichever strategy you pick, you probably need to be committed to it, all in, whether it's the active or the passive or anything in between. And I do want to just say really quick, Tommy, that there are different layers of active. So there's like the active passive, which we hire some active managers from time to time in our strategic or passive portfolio for a sliver. And then there's the active. The active is the people who are buying active managers and then actively trading all the time too. And then there's like the active tactical, which is like, I've got this universe of funds. I'm in and out of cash. I'm materially changing my investment allocation any given day. So for our audience, it's important for you to really understand if somebody says they're active or somebody says they're passive, there's always some level of active.
Right.
There's always some level of activity. So is it like the passive active, or the active tactical? And then being able to understand in the investment strategy, especially if you've hired somebody, is super important. So
well, I love it, John. Yeah, so we can go like super deep, and hopefully we've given you a good overview here of it. What's most important, I know that we come back to, is what is your financial plan? What is your cash strategy? And which one of these strategic fits with it? So it's really, again, control what you can control. We focus on those other parts I mentioned. Let's fit the plan. Let's fit the investments to that plan and be able to ride it out and appreciate that asset allocation should work for us. Like we've minimized all the risk we can, but they will remain. And this is why we focus on now the other things: taxes, cash flow, strategy. What are your goals?
I love it, Tommy. Well, let's go right into the next topic, which is helping our audience understand the difference between a mutual fund, an ETF, and an individual stock. And maybe we can just start with stocks and like, what is a stock?
So stock is just an ownership interest in a corporation. So could be Coca-Cola, just thinking of some big name, maybe Tesla, Nvidia, those are big ones right now, Amazon, Microsoft. You can own stock. Those are, you own a percentage of ownership in that company. So as the value of it goes up and down, you get to participate. If they distribute out cash in the form of dividends, you get a chance of that. If the company goes bankrupt, you've lost your investment, and you also get to vote based upon, in the general stock, like the most pure of stock, you get to vote. But typically in a publicly traded company, your ownership is so diluted that vote is not making a huge difference, but collectively that dictates what the board of directors and so forth who are running the company, what they can do. And I guess the natural next stop, so here's the stock, then there's also bond, right?
Mm-hmm. So a bond's basically a debt instrument. So it's like the company loans you money, or I'm sorry, you loan the company money so they could do something with it. And in exchange for that loan, they're going to pay you a coupon payment or an interest payment, maybe 6% or 8% every 6 months, a fraction of that every 6 months. And then at the end of 10 years, for example, you get all of your money back. So on a bond, you have this not guaranteed, but you have like predictable, steady income or coupon payments and really no appreciation because you're just getting your money back at the end of the day. Now, if you were to sell that bond somewhere in between years 1 and 10, you could be selling it at a premium or a discount based on where interest rates are. So what I mean by that is if your bond's paying 8 and the going interest rate is 4, your bond's very valuable. If your bond's paying 4 and the current rate is 8, your bond stinks and people are not going to pay you very much for that. It would trade at a discount. So if you hold it till maturity, you get your money back and you made 6%. Makes sense. Bonds are more, arguably more conservative. Stocks are more aggressive. They have different risks. So bonds are subject to interest rate risk. They're subject to the claims paying ability of basically that company. And some political risk too. Stocks, on the other hand, have an additional risk. Your stock investment could go to zero. You have all sorts of stock market risk, political risk, geopolitical risk, and more. So stocks and bondholders get paid first, Tommy.
I thought that was an important point. Yeah, bondholders get paid first, particularly like if we go to bankruptcy, bondholders are ahead of those stockholders in getting their investment back. So premise there, yeah, risk return, right? Bond, lower risk, lower return typically, and stock going to be higher risk, higher return.
And I'm buying stocks for either basically I'm looking at, are their earnings going to go up? So I'm like betting on the future earnings of that company. I'm also betting sometimes on the people, like a lot of people have purchased Tesla. I know Elon is in the news right now and Tesla stock is down as of this recording, but the company's innovative. They have the next AI. So it's the current earnings, the future earnings, and then sort of like speculation too. It's like that chance for material appreciation is why you buy stocks. You're typically buying bonds for the more stable income. Historically, individual stocks and individual bonds were not really investments that were not acceptable. Individual investors, most of the investing public, couldn't really build a diversified portfolio, Tommy, around individual securities and individual bonds, but that is changing a bit.
Yeah, and I guess the premise there, so kind of like how did we get to mutual funds and ETFs, was that, if a share of stock is $100 or $150 a share, and then a bond is 1,000 or more, depending on the face value of it, most people, you only have those denominations available in so many ways to begin investing, right? And so you can only buy so many shares, so many bonds, and then if you wanted to diversify, multiply that by X number of companies to try to get some diversification, just very quickly kind of got to a point where you didn't have enough dollars. It wasn't easy to do that. So by and large, here was how the mutual fund was born.
Yeah, and to be clear, to your point, Tommy, is fractional shares didn't really exist 20 years ago, 30 years ago. I mean, you couldn't buy just 0.1 shares of Google or Meta or what have you. You had to buy a full share. And also 20 or 30 years ago, technology isn't what it is today. Like, we used to trade by telephone not that long ago. And there were commissions and fees, and it was expensive and hard to trade. And so the amount of trades that it would take for you to buy 10 different stocks and 10 different commissions and 10 different et cetera, versus buying one share of a mutual fund that already owns those 10 companies, it was a much more efficient use of capital, arguably lower commissions, lower fees, diversification, fractional shares, exposure to a variety of companies. Now, in the last 5 to 10 years, that's changing a bit because some of these investing platforms do allow you to buy fractional shares of S&P 500 components, for example, but it's still arguably inefficient for you as the individual investor to try and create a broadly diversified portfolio of fractional shares where you could have just bought, I think VOO, right, is the S&P 500 ticker?
I think that's right. Let's double check because there's VO, VOO.
Yeah, VOO, Vanguard S&P 500 ETF. It's a lot easier to buy that than it is to try to buy 500 fractional shares of all the companies that exist within the S&P 500. And we're not bond trader experts, Tommy, but I don't think that the bond trading has become nearly as easy or efficient. So for individual investors trying to buy individual bonds, it does seem, my understanding, easier to buy fractional shares right now of stocks than it is to go to a bond desk, right, to buy these individual bonds.
There's been improvements in the bond market, but yeah, that one's a little harder to crack. And I think to your point, the mutual fund and ETF space has gotten so efficient by and large. It's just simpler. So it seems like, the technology is there and it's kind of cool to do some of these fractional things, but it feels unnecessary and still more complicated than doing it these other ways. So mutual fund, that was born from, hey, it wasn't efficient from me having enough money, a cost effective, et cetera, to go out and get a diversified portfolio. So now us as investors, we'll all throw in our $1,000 or whatever it is that we need for this mutual fund. They aggregate it all and say, well, now I've got millions. Now I can go out and I can buy all of these and I can administer it cost effectively so that you, individual investor, now own a piece of me, the mutual fund, and I, the mutual fund, own this diversified portfolio or this particular asset class or, whatever strategy it was we wanted to accomplish. So it made investing, accessible to many, many people, many more people to do it in an efficient and diversified or just more sophisticated way.
And inside of those mutual funds, you can have active or passive. Passive funds who just buy the S&P 500 or active managers like American funds who is maybe picking, a subset of those S&P 500 securities and trying to outperform. Fees are going to be different depending on the type of fund that you own. Strategic or passive funds are typically cheaper on the expense ratio. Actively managed funds typically more expensive. If you can trust AI overview on Google, the first mutual fund was established in 1924. I have not fact-checked this AI, but that's what it's telling me when I Googled it, and that's what Wikipedia says too. So hopefully that's right. Long time ago, 100 years ago, the first mutual fund was created. And they're still being used today.
Still being used today. Yeah, and like you said, John, different strategies in there, different expenses. The expenses, by and large, have come down quite a bit, even with those over time, like the ticker charges, the internal expenses. It still depends on what platform and what the strategy is inside of it. Mutual funds.
Oh, go ahead.
No, I was just going to say, so those were great. And I was thinking we would kind of pivot into how do we get to exchange traded funds. I know one of them is kind of the tax efficiency, but where were you wanting to go?
Yeah, so we definitely can't call this investing 101 because we've gone down rabbit holes already. So the mechanics of a mutual fund that makes it a little bit unique, and you're right, Tommy, I was thinking about tax too, is if you're contributing to a mutual fund, you get the price at the end of the day. So your money hits, the net asset value at the end of the day is what you purchase it for. If you were to sell a mutual fund, then you're going to get the net asset value or NAV at the end of the day. But then one of the things that really stinks about mutual funds is if you're the investor that holds tight and you don't panic in bad times, but everybody else in that fund starts selling, the mutual fund is going to have to redeem securities to give everybody cash. And at the end of the day, that's going to result in capital gain distributions that get passed on to every single shareholder, regardless of whether or not you sold. So if you went back in 2022 or you went back to any negative year, there are mutual funds that do, it's kind of adding insult to injury. You're already down and then you get a taxable capital gain distribution, which is really frustrating. That shouldn't necessarily scare you away from mutual funds, but we should be understanding of what we own inside of like taxable brokerage accounts, because even Morningstar does do like a tax efficient cost or a tax cost ratio based on these capital gain distributions. So that's kind of the mechanics. Mutual funds are also confusing. So like Vanguard, Tommy, has their normal shares and then Admiral shares.
Oh, yeah.
And the Admiral shares are cheaper than the normal share. So arguably you always want Admiral. But then it gets crazy. Then you go over to a company like American Funds. They have A shares. They used to have B shares. I'm pretty sure those have been outlawed. C shares, exist. A and C have the similar investments, but it compensates the commission-based salesperson differently. Then you go into F shares. And it gets even crazier because you have F1, F2, and F3 based on whatever cost or revenue sharing arrangement they have with TD Ameritrade, who doesn't exist anymore, Schwab, Fidelity, Axos, whoever. Then you go 529s, and there's 529 shares, 529A, 529C. And then you get even crazier because then you get into retirement plan shares, and you have R1, R2, R3, R4, R5, and R6. So the same daggone fund, I don't know how many shares that is. It's like 25 different share classes.
Typically, you just want to get the lowest share class you can and you qualify for, but it's worth being wise or having somebody in your corner, like an advisor who can say, like, yeah, A shares in the right share for you. We've got institutional shares available. So yes, there's many. So that can certainly be confusing, but you want to look for the lowest cost share.
So then ETFs, exchange traded fund, or ETF for short, Tommy. Again, if you can trust whatever Google AI is spitting back at me, this surprised me. When do you think the first ETF was launched?
Yeah, that's interesting. It feels like a more modern thing of when it took off, but I don't know. Maybe it was like in the 70s.
You're closer than me. I was 1993, first ETF, Spider S&P 500, SPY, launched on January 22nd, 1993. I was thinking it was in like the 2000s or something. Oh,
I knew there was like kind of a trick to it. It's like, it feels like this was a very recent, but I'm guessing the first ones are going back further than, because for a mutual fund to have existed in 1923, clearly it took a while for it to like become, really accessible to the public. So yeah, so the 90s makes kind of sense. Technology was a little more advanced, obviously, than in the 20s.
So and I was thinking, the Mutual Fund Investment Act or whatever of 1940. I was like, well, that seems like when the first mutual fund would have existed, around the same time as that 1940 Act, but almost 20 years before that. And I don't know, I remember in 2010 or so when I joined, investment managers and reps from like ING or wherever were coming over, and they were like, "Hey, we've got these new ETFs," and it was they were new.
Yeah, I agree. That's when it kind of seems like it was really beginning to take off and more access to ETFs when they became prevalent. Is in that time frame you're talking about. But so an ETF is, my way of thinking of is like just take everything you learned about a mutual fund and now translate that into an ETF. So we're just grouping a bunch so that we can go then buy cost effectively. Where the differences come in is this is now, I think John mentioned, you go to the mutual fund, it's placed at the end of the day, the closing value. ETFs are traded throughout the day. So those are on an exchange. You can buy or sell whenever throughout the day on the exchange. And they're more cost efficient. So typically, again, there's some mutual funds out there that are very cost efficient, but ETFs don't pass through those gains, or at least not typically, like John was talking about. So a lot of times, particularly in those non-qualified accounts, those non-retirement types, we like to use ETFs. I mean, we like ETFs in general because they're not going to pass through those unexpected capital gains. They're just a far more, by and large, tax efficient. But very similar to a mutual fund. But those are some of the main differences that I can think of. There's probably more, but those are the headliners.
And I don't claim to be the smartest person of all time. I don't know that there are different versions of ETF shares, right? Like an ETF is just an ETF, so it's a little bit simpler.
Yeah, because I think you then would have a different ticker. Yeah, right. So I think neither of us is 100% on this, but we haven't seen, to our knowledge, different classes. So it's just the ticker is what the ticker is.
And it's different because I think with mutual funds as well, if it's an open-ended fund, they just continue issuing new shares all the time versus a closed-end fund. There's, however many shares that exist that can be traded. I think an ETF is more like the closed-end fund, right? There's only so many ETF shares. Or do they continue, Tommy, issuing new shares all the time?
It's like very kind of, I think, complicated as to how the ETFs work from that, because I think they do create additional shares, but they do it in a way that doesn't like impact the existing amounts. I forget how to explain it, but people are like buying VO. More people could be buying VO, and I think they go and they create additional amounts, but they don't have to redeem and go through the same exercise like a mutual fund does to create it. And that's another part of where they're more efficient.
I love it. So we use a lot of ETFs for the flexibility, typically a little bit less expensive than the mutual fund counterpart. But like we said earlier, mutual fund fees have come down, ETF fees have come down. The spread between the two is not as big as it used to be. And one of the things you have to watch out for with ETFs, specifically my understanding, bond ETFs or more thinly traded ETFs, meaning positions that don't trade as much throughout the year, is you always have a bid and ask spread, Tommy, between those. So ETFs can be inefficient in that you're paying this kind of hidden cost between the bid and ask spread, where I guess an audience, I don't know, we're not, again, trading experts here. We more focus on the planning, but you do have to worry about that with ETFs, or I don't think you have to worry about that as much with funds.
Yeah, you're correct, because so a mutual fund, when it goes to give you cash, redeem shares, I mean, they're saying like at the end of the day, everything we owned here was what it was worth, divided by whatever you're asking for, your shares, that's what you get. So it's what the assets were valued at. Whereas the ETF could be like, hey, I'm trading at a penny or two less than what my actual underlying withholdings are. Like if you actually own those and went to sell, typically it's very slim, particularly on a very largely traded position like an S&P Vanguard 500 type of thing. But you're correct, yes. So we do need to look and see like how efficient are they there, so that there's not this huge spread between what the underlying assets are worth and what the ETF is trading at. It should ideally be priced at exactly what the value of everything it owns is.
Agreed. I think we've heard it called as slippage before, right? Like, then we hear that term.
Yeah, slippage, spread. Yeah, there's different. And there's a lot of complexities here if you really get into the weeds. But I think that's probably going far deeper than we need or want to go today.
So I thought where we go next, Tommy, is talk about market makers. Just kidding.
You want
to Just kidding.
All right.
Yeah, that's if I study the series 24 again, back from our commission days. I'd be more up to date on market makers and all those kind of things. But why don't we kind of hit cash strategy and dollar cost average now?
Yeah. So when I think about cash strategy, it's kind of what's your emergency fund? How are you meeting your spending needs? Like, where is income coming from? Social Security, pension, portfolio, all of those. What is our cash flow strategy, as well as how are we earning interest on the current cash we hold in the bank? Those are cash flow strategies. And the big one is, how am I going to meet my eat, drink, and be merry? How do I pay the mortgage? How do I live month to month? What's the cash flow strategy? And your portfolio should be aligned with that as to how aggressive and conservative is it? How is it going about the distributions? And what are the tax ramifications of those distributions? So, John, at a high level, that's how I think of a cash flow strategy, and it all needs to fit together.
I agree with everything you're saying. Going a little bit deeper into how I think about my cash strategy too, is I kind of like to have half of my cash liquid and then kind of half of my cash tied up a little bit. And when I mean tied up, it could be like a 18-month CD or a money market mutual fund, government money market fund paying between 4% and 5%. So some money at the bank, some money in like a higher yielding. I'm not super jazzed about making my life too difficult by having all my money in a money market mutual fund and then having to do like sells and transfers all the time. So find your happy zone where you have enough in your liquid cash and then have your like cash that's actually doing something and earning something for you. So there's like money market mutual funds I think can be really great. High yield bank accounts can be great as well. 50,000 for our retired clients feels like a good number for a lot of folks, but we do have some folks who want to keep about 100,000 or more in ready access cash. So it does go back to your individual plan, Tommy. And in our investment portfolios, we try to keep about 1% to 2% in cash. Ideally closer to 1%, but sometimes we creep a little closer to 2%. And then sometimes in non-qualified accounts, it can go a bit higher, because we're not trying to realize a bunch of capital gains for no reason. So non-qualified portfolios are always harder, but a good target for a managed account is somewhere between 1% and 2% in cash.
That's correct. And then again, the portfolio strategy that fits within it, which is, hey, good times, bad times. Yes, the account's going to be down, or at least it's going to say it's down based on what the market's doing right now, but it's diversified. It's got the correct asset allocation. It's built on a long-term strategy. So it's going to reliably kick off your monthly income that it's supposed to, like we said. And we never were expecting so much from it that now we're scared. Like, it's all part of a stress test plan, right? So that's part of that cash flow strategy. We've got Social Security or don't have it coming in, the pensions coming in. So all of this adds up to our goals. And maybe there's one-off distributions and looking at, is that okay, not okay, is now, I say a good or a bad time. Again, typically we're planning 30 years for you, where if that was in the plan that we were taking a big trip and now we need 20 grand, even if the market's down, sometimes, maybe we could have got in front of it. A lot of times, no. Like we said, things happen quickly, but it's okay. Yeah, we're down. The S&P could be down 10, but maybe your bonds have appreciated as part of that asset allocation. So your portfolio is only down somewhere between 5 and 7, and it's all part of the plan. So it's okay. And let's look longer term. I'm just thinking some conversations I've had here was like, hey, is now a good time? It's like, well, let's look a year or two from that last bear market, and we're still way up from that one. So this wasn't as good as it was a month or two ago, but this is still a very opportune time to take that distribution. But at the end of the day, the portfolio, we really zoom out. It was designed for this. It's designed to go through this market and still support your cash flow, or it should have been designed that way.
Big expenses, to your point, one-off big expenses don't typically hurt your financial plan. A consistent butt whooping of high expenses will hurt your financial plan.
Particularly when all of a sudden we go down.
Committing to boats and second houses and RVs, and you stress your plan and you put a lot of guaranteed expenses in your plan. Sure, like that's going to be stressful. But if we just assumed a 5% withdrawal, Tommy, on assets for easy math, if a client comes to you and says, okay, Tommy, I need 100 grand. Like, okay, so you can take out 100 grand, and worst case, that probably reduces your retirement income by $5,000 a year or $400 a month. That's not that significant if you have to do that every once in a while. But chances are you could do that one-time expense and not have to reduce your living expenses. I'm just kind of trying to paint the picture that when you think about extracting that much value one time, what it does to your monthly flow is pretty small, even if you did have to adjust down.
Yes, yeah, and there are ways we look at things. Sometimes, many times, we don't need it, but others are. All right, we just took a large withdrawal. Market's down 20%. You're continuing to take large withdrawals. Probably need to have a conversation about making some adjustments to shore this thing back up, make a cut, as John said. But many times these are discretionary expenses. Yeah, 5%. It's like, okay, that's fine. That's what this portfolio is here for. Let's revisit next year, or maybe we kick it. We probably don't need to kick this down the road, but let's take it. It probably was a discretionary expense to begin with. So maybe next year it's 80,000 we're thinking about on a one time instead of the 100,000 or so forth. So it's just understanding all those ramifications and what a good planner's here for. The issue is, hey, we started out aggressive and we continued to put a lot of stress on the portfolio. Then we went through a rough market to put even more stress on it. Now we're really in decision time versus it's fine. Normal fluctuations, healthy distributions to begin with go through pretty much any market.
I love it, Tommy. So kind of wrapping up the cash strategy, let's quickly hit on dollar cost average. And we do this a lot with clients. And one of the reasons that we're hired is not to necessarily babysit people, but sometimes the people that we've met have made decisions to exit the market or sell and go to cash or TSP G fund. And they did that whenever, 2008, 2020, 2022, and then they get cold feet and they never know when to get back in. So this goes back to the active passive debate is once you got out, it's really hard to get back in. You need a mechanism to get back into the market. A lot of times the folks who have excess cash or excess G fund are saying, I'm just waiting for the opportune time. And then it's like, well, you be sure to tell me when that is, because it seems like almost every year something scary is happening.
Oh, and it's investing, right?
Yeah. I mean, in my experience over 15 years, I'm not sure that if I had $1 million in cash, that I would have ever necessarily classified something as like, this is the time I have to get in. Like right now, this is the opportune time, deploy $1 million. I'm not sure that I've ever had that much confidence in 15 years. So I would dollar cost average.
Yes, I agree. There have been opportune times, but one, it was having the cash and then having, the guts to make that call. Not easy to do in those situations. And you have to get it right if that's your strategy. Much more probabilistic to be invested. It'll work 3/4 of the time market goes up. Let's stick with that strategy. Dollar cost average, this is, I think what we see a lot too right now is COVID scared people or the inflation scare when the market went down in 22. They got out and they haven't figured out how to get back in and they've missed a lot of gains. And usually the conversation is fun like that. Will you be sure to tell me? And when they're pushed, it's, well, I'm not trying to get it perfect, but the problem is like, I'm frozen, right? Like I'm just frozen as to making a decision on this. And so behaviorally, one of the things we like is this dollar cost average, which says, let's take the $1 million and let's agree to a time period that feels comfortable. We'll just use a year as an example. Over the next year, we're going to take that $1 million and just piecemeal start deploying it into the market. And the idea is that it's momentum. Let's just start taking some steps and keep that momentum going. And then it'll help smooth out volatility. So instead of us throwing $1 million right back into the market and we chose the worst possible day and now you get to experience 20% down, that's not fun and doesn't make any, that's probably just not going to lead to success. Whereas we don't know what's coming. So let's do this over a year so that you can buy at various points. If the market goes down throughout that year, you got to buy at cheaper and cheaper prices as you were buying in versus all $1 million just depreciating. It can work against you. If the market is going up over a year, you're now buying at higher and higher prices. But again, it's the momentum of you probably weren't going to do it ever. So now let's just begin purchasing to get back in. So it's behavioral, it smooths out the volatility, and we like it a lot to get people back into the market when they're coming from a place of like, I made a decision years ago and I just haven't been able to figure out getting myself back in.
So we'll typically use a money market mutual fund earning 4 to 5%, and then we'll dollar cost average into the market from that. 12 months is pretty common, Tommy. And as you said, one of the negatives is the market could go up while you're dollar cost averaging. And that's also what makes it so hard to get back in from a cash position, because if 7 out of 10 years the market's up, every year that you've been in cash, you're like, it's higher than it's ever been. I'm not, it's like eventually we just need a systematic approach or a mechanism to get this money deployed. And I have 2 clients in my head right now. One, I think they're both dollar cost averaging over 5 years. And that is a long dollar cost average. And the audience is probably like, what are you doing? Well, one person may or may not buy a house. We've been sitting on $200,000, $300,000, $400,000 in cash for 3 years, 4 years, 5 years. And home prices have gone up, interest rates have gone up. So we had an honest conversation. We said, are you ever going to buy this house? Probably not. But if the right house comes along, I want to be able to. So it's like, okay, let's DCA over 5 years. Like, let's at least do something. And that way, if this house does come available in April, then we haven't deployed all the money right before the butt whooping. The other person may have some ability to buy some additional company stock in the future, but we don't know when or if that stock will ever become available. So we could be paralyzed and sit in cash forever, or we could kind of like conservatively over 5 years get this money working for us, knowing that we'll probably be able to build savings over that time too. So design it for you. The DCA is an awesome tool. It's a mechanism to get that money deployed. 6 months, 12 months, 24 months, whatever works.
Don't let perfect get in the way of good enough there. It is a great mechanism. It's not without its own flaws, but it's a good mechanism to get you in there. It's better than nothing. And one of the things John and I were talking about, kind of sketching out this episode before we got going, was many times our federal retirees can come to us, and if they've done the whole career, what their pension will be plus Social Security going to cover their lifestyle, their current lifestyle. Like many times that's the case. Most of the time that's the case when we look at it. It's like, this is great. These things fund your have tos to maintain that standard of living or very close to it. So it's like, why take on the risk? I could just sit in cash. But that's where we, again, look out over a 30-year retirement. And we're like, well, you could meet your needs or you could live your best life. You could live a great life. You could have flexibility, options, get to go out and have an awesome retirement. And that one, you probably need to take on some risk. We want to minimize as much of it as we can. But if we put that portfolio to work, man, your plan just got so much better and more flexible. And the entire time you keep your needs covered anyway with that pension and Social Security. So that's a real fun conversation. We can say, look at how much more we could spend or the different things we could do. And so now let's put the mechanism in place to get us back into that portfolio that over a long term is going to give us more flexibility. And even if something like long-term care comes along, having that money invested so that when that event comes along, again, that money was working for us to help with it. So that's why maybe we didn't have to take on risk, but we don't always want to live with the haves or the needs, right? We want to have the best we can with the least amount of risk.
And it also continues, Tommy, towards it could increase what you do to charitable contributions, can increase what you do to as far as like legacy planning and generational wealth transfer and the ability to go on vacation with your kids and grandkids or pay for your grandkids' college. You just start thinking about the opportunities. It doesn't necessarily have to be for you, the retiree or the client, but you start thinking about the power of compounding and the power of investments and the power of being in the market earning real returns and what that could do for you, for the community, for your family. It's a big deal. Let's skip really quickly over muni versus corporate bonds and just say that municipal bonds and corporate bonds are very similar. We told you we would talk about them. We're going to gloss over it today. Corporate bonds you would typically buy inside of an IRA or Roth IRA or a taxable brokerage account. Corporate bonds typically have higher yields or higher coupon payments than municipals. I guess you could argue that corporate bonds maybe are a little more aggressive than municipal bonds, but
depends on the municipality, I guess.
correct. But corporate bonds, typically higher yield. You would typically own those if you're in a retirement account or you're in a relatively, low to moderate tax bracket. Municipal bonds there's different kinds, but generally speaking, we will start using municipal bonds when clients start to encroach on the 32% or higher federal tax bracket. And then depending on the client, you could even layer in some state municipal bonds, and the state municipal bonds may have some tax-free state treatment too. So what you're looking at, Tommy, is I'm giving up yield on the municipals, but I'm getting tax-free stuff. So at what tax rate does the tax-free lower muni actually provide a better return than the corporate? It doesn't appear that that's below 32%.
No, which makes sense because that's, market smart. It's pricing things accordingly, right? So that's typically you had to be in a very high tax bracket or maybe live in a very high tax state, but then do the math to figure out like what your tax equivalent on a corporate versus a muni is based on your situation to get you to that right answer. As you went through, John, there's some different risk characteristics and they're all very specific to kind of, is it California bonds? Is it US bonds? Like, what are we talking? Virginia bonds? So there are some individual things that you have to look at to really get it down to where but that's the high level.
And both of those are available as individual securities or in a bond
basket, like a mutual
ETF
fund or ETF.
Fund. Exactly. Yeah. So wrapping this up, audience, we want to discuss products, aggregators, and financial planners. And investments, generally speaking, are a product. Your investment could be pretty simple product consisting of ETFs, mutual funds, and stocks, or it could be a very complicated product that consists of things like variable annuities, index annuities, life insurance policies, whatever the strategy may be. So it's important to understand that the investment product that you own should coordinate with your financial plan. But purchasing an annuity or purchasing a mutual fund or purchasing an ETF in itself is not a financial planning strategy. We all have to purchase something if we're going to be invested. Even if it's just cash, we have to buy something. We have to allocate our money to some type of product. So understanding that a product is just that, should be a piece of the financial plan. It's how you allocate your money is to a product. Then we think about like the commission-based salesperson or some of these big mega, Tommy, RIA aggregators of assets. And the products among those two people are different. But globally speaking, both of these people are product salespeople. The commission-based salesperson is selling you whatever he's selling you, and he's going to get paid one time and he may never call you again. Granted, there are really nice commission people who probably don't operate their business that way. Then there's the RIA aggregators, we won't call any names, who get all your money in and say, we charge you a fee, we do better when you do better. And they allocate you to a product of investment portfolios, and that's all they do for you. And they charge you 1 or 2% to do that. But in either scenario, all these people did was help you purchase a product. They didn't actually maybe they added investment value. Maybe they did add some money on the investment side. Maybe they did help you select a good product. But there's a fundamental difference between those two people, Tommy, and like what we do at Mason as what we would say like financial planning actually is. So maybe you can share that with the audience.
Yeah, I'm even thinking like in my mind visually, it's like a circle of like planning, and then it's like the product within it, whether it's the managed portfolio or perhaps an annuity, whatever it is. It's like those are pieces of financial planning, but they are not financial planning, right? So again, the big circles of financial planning, and these are all pieces: tax planning, estate planning, risk management, cash flow strategy. Those are all in that circle of financial planning. So advisor is there to, help you control what you can control, align these different things to your individual plan and circumstances, And their value is somewhat these individual pieces, but it's adding up to the greater whole, and the bigger piece of that being the advice, pulling this all together for the ultimate strategy and walking alongside you to give you advice and be your partner throughout this journey, or as long as this journey that you go together is.
So a rectangle is a square, but a square is a rectangle, but a rectangle is not a square, right?
Square is a rectangle, but a rectangle
is not a
square. I think that's correct, because a square has four sides, but equal, right? Whereas a rectangle has to have unequal.
Yep, exactly. So I kind of think about that when I think about the commission-based salesperson, product person, or the RIA aggregator person. They're the rectangle. And then the financial planner is the square. Like, they can do all of those same things that those other two people can do, but they're a square, and they're materially different in the offering that they have. Like, the product offering at Mason and Associates is the service and the value of all of the services that we provide, federal benefits, everything that you hit on, Tommy. So a square is a rectangle, but a rectangle is not a square, is kind of how we want to differentiate the sales or product people versus real financial planning. So hopefully that'll help the audience, as they think about potentially hiring, or just the difference between one versus the other.
Right. And as I even think about it, those are great, John. And is the person you're talking to, are they just talking about the product, that managed portfolio? Are they spending forever talking about it? Are they spending forever talking about this annuity, the bells and whistles of it? And maybe individually those things are fine, but that's not an advisor. And they shouldn't be charging you the same as an advisor. And you won't hear us typically spending a lot of time belaboring these points with our clients. We're really talking about the other things we can control while taking care of these. And that's the planner.
Well, another great episode, Tommy, of the Federal Employee Financial Planning Podcast. Folks, is our content helping you make more informed decisions? Do you feel more educated and empowered? Have you made positive changes in your financial plan? If so, please be sure to share those in the comments section, or send us an email to masonfp@masonllc.net. MasonFP, like financial planning, at masonllc.net. Please do all the things, like, subscribe, share with your friends, your family members, your coworkers. We want to continue bringing this message across the country to help you, the federal employee. Thank you for tuning in to another episode of the Federal Employee Financial Planning Podcast. Remember, we're financial planners first, we do this second. And as always, we hope you leave this episode feeling educated and empowered.
Thanks. It's always enjoyable.
The topics discussed on this podcast represent our best understanding of federal benefits and are for informational and educational purposes only, and should not be construed as investment, financial planning, or other professional advice. We encourage you to consult with the Office of Personnel Management and one or more professional advisors before taking any action based on the information presented.